Mergers and acquisitions. More precisely, we're here to learn how to maximize the value of your company when you want to sell it. Get ready for that and prepare for the optimal outcome, as we call it, so that you're happy, you're rich, and you retire after you've built such a great company. My name is Jim Perkins. I am a regional director at Quorum Group. I'm also a digital media specialist. And let me tell you a bit about myself. I actually, like you, was in the game business, and I'm in the game business. Have been in the business for 22 years. I published a lot of games in the early days. You may recognize Wolfenstein, Duke Nukem, Doom, Unreal, Quake, Driver, a couple of others. Did very well with those games. In fact, in the early days when I was in the video game business, everything was online through CompuServe. Retail really wasn't happening yet, and it's kind of ironic that we went into the retail and now we're going back into online games here today. So we lived through the early days of selling games online and getting people to buy, or at least try our free games and then buy the premium game. Quorum Group is an mergers and acquisitions firm. We essentially represent entrepreneurs only in the software business, and I specialize in the video game business. We have offices worldwide. We have them throughout Europe, throughout North America, and other parts of the world. We've been around for 26 years. We've done 270 plus transactions, creating about $1.6 billion in wealth for entrepreneurs like yourself. And specifically, we only represent the sell side. So if you're an entrepreneur who built a company, started a company, we help you sell to the larger companies. We know all the guys at Zynga and Big Fish and other big acquirers that would be candidates for buying your company, but we represent you and only you when you're selling your company. We've developed a process called the optimal outcome M&A process that helps prepare you and help you sell your company. And the team approach is very important. We have lead people on the team that were CEOs of entrepreneurial companies that sold their companies. We have research people, we have writers, and all those people to help you prepare to sell the company. We also run educational seminars. We run 2 seminars. One is called Selling Up, Selling Out. It's a half-day course. Pretty intensive boot camp. I'm going to try to put that into less than an hour here today. We also run an hour-and-a-half merge briefing, which gives you an overview of the mergers and acquisitions market, and it's a shorter version of how to prepare your company. We run those virtually every week around the world. It's quite an amazing. We've educated more people on M&A than anybody in the world. We also have a huge database of buyers, over 135,000 buyers, that we know their habits in buying, we know what they do, what they need in terms of due diligence and the rest of it. Also, this is a book on the deals that we've done, and I also have a World Tech M&A report, which came out earlier this year. I can send these to each of you. Just leave me your business card or email me at jimp@quorumgroup.com. But I encourage you to leave your business card up here, and I'll send these to you right away. We have some great materials for you to review. We have many industry leaders in our company. One of them is Nat Burgess, our president. He is quoted repeatedly on CNBC in North America. Funny enough, he recently predicted that Microsoft may buy or invest in Barnes & Noble, and everybody thought he was out of his mind, and in fact it actually happened. So somewhat of a visionary. We do deals around the world. You can see some of these deals here. We've sold to Google through U.S. companies. We've done business in Sweden, Australia, Norway. We did a deal with Apex here in Singapore, selling to NTT Data in Japan, and so on. So what I'm going to do today is give you an overview of what's going on in the marketplace. I'm going to talk a little bit about M&A activity and valuations. I could also talk about the 8 required stages in terms of going through the M&A process. I'm also going to talk about deal disasters, what to avoid, prepare, or this is not what to do. You want to avoid doing these things if you're planning on selling your company. And it's good to start early. And the other thing is to get educated. Get up to speed on what it is necessary to sell your company, learn from others, talk to other people that have sold their companies, and so on. All right. Now, this is a general tech overview of what's going on in the industry. This is what Gartner Group is saying what is happening, this top strategic technologies. And these really do apply to the video game business. First is media tablets and beyond. They expect iOS and Android to dominate, and that affects our business dramatically in terms of how we make games and where we make games. Mobile-centric applications, more than 70 billion devices worldwide by 2014. That's not far away. That's a year and a half away. Also, social and contextual user experience, very important. We've seen that in the video game business more than anything with the prominence of social games, social mobile games, and so on. And remember, they're predicting this for the entire technology industry, but we have applied this for video games repeatedly. Application stores and marketplace. That's obviously recognizable to you. The internet has everything being used for cameras, sensors, absolutely everything. And analytics. Very important. And when it comes to big data, we're going to be consuming more data and more video than anybody. In-memory computing, these are some of the other ones. Low-energy devices and cloud computing have become very, very important. It's a big battleground for Google and Amazon. One of the interesting things is when I was selling my companies, and I've actually sold to video game companies, to larger companies in the past, and I always thought the way to go to create wealth was an IPO. Well, in fact, the way to create wealth is through M&A, is to sell your company. Going through an IPO is very difficult. It's pretty rare, and after the case, it's very, very stressful. And I have been part of companies that have bought my company that are public companies, and it's tough being part of a public company because you're constantly under scrutiny. The other interesting part about M&A right now is that cash is king. Cash is everywhere in the business. These are some of the biggest companies in the business, but this could be said for Zynga, who has $2 billion to spend in cash. Apple, look at the increase over 2007 to 2012 in terms of how much cash these guys have. Most of the M&A deals today are cash, which is great. You may do a combination of cash and stock. You may do a combination of cash and earn-out in stock, but there's cash involved. When I was doing my deals, a couple of my deals, they were stock deals, and I had to wait 12 months to sell my stock in a company. All right, what's been going on in M&A? Well, actually, mergers and acquisitions follows the trends of the economy. You can see here that in 2001, after 2001, mergers and acquisitions decreased a bit. Then it started to peak in 2006, 2007, started decreasing after the stock market crashed in 2008, 2009, but it's increasing dramatically now. The deal volume, as you can see in the blue, is going up. There's about 3,800 deals done expected to be done in 2012, worth $250 billion. These are some of the top strategic acquirers in 2011. No surprise here that Google is the top acquirer in the business, and there are many of our businesses that are attractive to Google. Keep that in mind. And I'll repeat this as we go through the next 45 minutes, is that who you think your buyer is not necessarily the buyer of your company. It could be Google. It might be Zynga, but it could be Facebook. It could be a company that's outside of the country. Most of the deals that are being done in M&A are cross-border deals. So about 60% of those deals are cross-border deals. So you may not know who your buyer is. So it's important to have a list of buyers out there, or have a professional get you a list of buyers that could potentially buy your company. And I bet you half of them are overseas. Zynga did 13 transactions, and I'll get into Zynga in a little more throughout this, but Zynga did 13 transactions and almost one a month in 2011. I think they've done 6 already in 2012. Very, very active, looking for highly talented people or products that challenge them on the charts like OMG Pops, draw something. And here's a good indication of what's going on in the video game industry. What we're seeing is a massive increase, and this is due to Zynga and other companies. Electronic Arts is very, very active, and a number of Asian companies as well have been very, very active in terms of buying companies in 2011. Again, following the trend, but major league uptrend here in video game mergers and acquisitions. This is what private equity people are doing. These are companies that are putting money into your company to help it grow. They're helping you to they want to see you as a strategic investment and then eventually liquidate the company or sell to a larger company. Now we do something called a quorum index here, and we measure the amount of transactions happening in the world from year to year. The number of transactions increased about 15%. The largest deals, some of these large deals are significant. It's gone up 62% in the last year, some big mega deals. And then there's some other things. Number of VC-backed exits has gone up by about 20%. And the all-cash deals, about the same. But 43% of those deals, again, are all cash. Pretty impressive compared to even 5 years ago when a lot of the deals were stock. Tech M&A is going to remain very strong. We're seeing an extraordinary change in the world. There's obviously interrelated megatrends going on. There's interrelated technologies going on, social, mobile. For you guys, it's obviously social games, mobile games, MMOs. All of them are converging in the market. And the acquirers of those companies can be competitive companies or they can be complementary companies. And I'll get into that a little more. We've got a session after this about market trends and specifically what's happening in different regions and different parts of the video game space. But we're seeing a lot of people trying to consolidate in various businesses to become more competitive in their world. Oh, I should go back here. I mentioned that strategic buyers do have record cash. The debt is at a lowest cost ever. People could borrow money for virtually zero amount, and that's why the cash is up so much. Private equity companies raised a whole bunch of money in 2007, 2008, 2009. They have to spend that money. They have to spend it soon, otherwise they're not going to return the investment or give the return on to the people who invested in them on their equity. If it's sitting in cash, it's not earning any money. So they need to invest in companies, and that's happening now. And there's a lot of new foreign buyers. As I mentioned, 60% of the transactions are happening cross-border. There's a lot of buyers out of China, India, Korea, Japan. A lot of European countries are buying in the U.S. especially. Also, there's non-tech buyers. And this is what I mean by companies that you may think would be your buyer or may not think to be a buyer of your company, but they are actually a buyer of your company. And what we do at Quorum is put together a database of who we think those buyers are. And they may not be in the industry necessarily, but we know that they are buying video game companies or they are buying platforms that could be useful in other places other than video game companies. American companies are cheap to foreign investors. There's a lot of money being invested in American companies right now, and I'll get into some detail of that in a minute. Most U.S. buyers, cash is international. So a lot of the companies like Microsoft and Google, their cash is wrapped up overseas, and they can't bring it into the U.S. Good thing for overseas companies that want to sell to U.S. companies. They have to keep their cash outside of the U.S., so they're buying companies outside of the U.S., like Skype. Microsoft bought Skype for cash, and it was a huge amount. And every company, as you know, software is becoming more and more important. HP, IBM, everybody. And that's just not gaming. That's just, it's all applications, all software solutions, software services, and so on. All right, selling your company. Any questions so far? I'll take questions at the back, but is everybody on the same page so far? Great. All right. selling your company does require a lot of time. You don't sell your company within a month, expect it to close within a month. It just doesn't happen. Fastest deal I've ever seen is 6 weeks. That was the OMG Pop deal with Zynga. And OMG Pop was really ready to sell. I mean, they had prepared. They had had their company for a long time. They put their due diligence together, and they prepared to do the company. So that's why they sold for $180, $200 million. They threatened Zynga's position on the charts as far as games are concerned. But they were prepared to sell their company. There's a lot more to do than you realize. Due diligence really creates a lot of work, which, in fact, you don't want to do. You want to have somebody doing that for you so that you can run your business. And I'll get into that in a moment. Now, we actually looked at this, and self-managed transactions, self-managed sales of companies, actually 80% of those fail. If you're trying to do it yourself, it's really tough. And so that failure rate is pretty high. So it's really important when you're doing that really important transaction of your life to have help. Yes?
How do you measure that?
We track as many companies as we can.
But how do you know whether I'm talking to ABC?
We don't. But we've seen a lot of companies. We talk to a lot of companies, and we don't know all of them that fail, but we talk to a lot of people that are trying to manage their business, and we see that rate. That is pretty educated guess on the companies that we deal with, given the database that we have, which is, again, about 135,000 buyers. The inherent problem in M&A is that the buyer and seller are at opposite ends of the pole. A buyer is looking for the lowest price. They're looking for the best structure. They're not worried about the seller's liabilities or taxes or other things like that. The seller really is interested in price. They're interested in cash, minimizing liabilities, minimizing taxes, and so on. So first and foremost, you have to remember that you'd be diametrically opposed on everything. We actually measure the sale of a company by what we call optimal outcome, which means it's more than just the price that you get for your company. It's the value maximization of the company. It's reducing the risk, minimizing the risk in this transaction, and also structuring the deal to make sure that when you sell the company, and you most likely will be working for the buyer of your company, that you will have the best possible structure when you're working for that new company. So these are the 8 required stages of the M&A process: preparation, research, contact, discovery, negotiation, due diligence, closing, and integration. And let me go through these quickly. Any questions? All right. The first is preparation. Set out some tasks and timeline, what you're planning on doing. It's very important to allocate a certain amount of staff to prepare the necessary materials for your company. What you're going to be preparing is an executive summary, a financial memorandum, PowerPoints, and so on and so forth. And in fact, it's best if you get somebody to do that for you. If you have somebody professional that can pull that together for you while you're running your business. Somebody to help you prepare those materials. You need to do some research, and this is really critical. Find out who your buyers are. There are different levels of buyers. They could be your competitors. They could be your partners. They could be people you don't know overseas. But it's really important to find out what kind of buyers are out there for your company. And put together a comprehensive list. What we do is we'll put together a very significant list of what we think a global view of buyers are. It could be 80 to 100 buyers that potentially looking at your company. We then start to narrow those down and categorize those into special groups, whether they be competitors, the current partners, complementary business, people that want to grow outside of their country into the country that you're in, and so on and so forth. We also prepare a preliminary valuation. Now, we don't tell people what we think your company is worth, but we do a preliminary valuation so that we have an idea of what we should be looking for when we're selling your company and people are bidding on the company. We also, in terms of research, it's important for you to get the highest possible contact when you're selling your company. That's got to be, in terms of an acquisition, it's got to be the CEO level at the buyer. Can't be the vice president of development, can't be the vice president of research and marketing, can't be any of that. It's got to be the CEO. You've got to go after the CEO. And what's really important, and we're dealing with Google or Microsoft or Zynga, we're dealing at that level, very, very senior level, so that these are decision makers. These guys know what they need to do to grow their company through an acquisition. And it's also important when you qualify them. You don't want, I've seen situations where we're dealing with a vice president of development. 8 months later, he says, well, I'm not really the guy you're supposed to be talking to. You've just wasted 8 months trying to figure out if this is the right guy to sell the company to, and he's not. It's also important, and getting an intermediary is very important, because when you're negotiating, do you want to be negotiating potentially with your future boss? No. There's going to be emotion involved. There's going to be a lot of, very strategic maneuvering and all of that, and you don't want to be negotiating with your future boss. You want somebody else to do that. So that research and that preparation and getting an advisor and helping you to do that is important. And then what we want to do is create an initial contact with those potential buyers. What we do in this case is very effective. We don't identify your company, but we do identify what your company does and why your company would be valuable to a buyer. And that really weeds out who may be interested in your company and who may not be interested in your company. And you'll get some very quick response from what we call rabbits. And those guys, within a week, they're saying, yeah, I really like this. And they pounce on it. They make an offer in a few weeks, and it's a very low offer. They're just seeing if they can get you for a good price. That's a good thing, because at least it's established some activity in buying your company. But it's also important, if you're dealing with competitors or you're dealing with partners out in the industry, you don't want to identify yourself right off the bat. You want to make sure that that's anonymous, and that'll help you weed out who is interested and who's not interested. Discovery, a lot of conference calls, a lot of calls to get these guys engaged, and I'll tell you, I'll give you an example of how much work it takes to get these guys engaged, buyers engaged, because they're getting constantly pounded by people who want to sell their company. And it's important to stay on these people who are interested in your company. Say, yeah, we want to set up a conference call with the owners of the company. We want to go on site to present a PowerPoint to them, or whatever the case may be. But really critical to keep that process moving and that discovery process moving. When we do, what we do is, in terms of discovery also, a lot of people think that the buyer should only be doing due diligence on the seller, right? And that's not the case. The seller should be doing due diligence on the buyers. Think about who's potentially interested in buying your company. Do they have the cash to buy your company? Are they a company that you want to work with? How's their reputation in their business? Go and talk to some of the companies that they bought. Come talk to their owners, see how happy they are, see how that turned out 3 months, 6 months, 2 years later. Then the negotiation starts. This is where you organize and host the final visits. You provide some structured guidance in terms of negotiating. This is a simultaneous process with multiple bidders on your company. This is not, let's work with one company only to negotiate the best price for my company. You've got 4 or 5 people at the table, maybe 2 or 3 people at the table, and you need to have them bidding against each other to buy your company. And you keep that simultaneously going. So it becomes very busy and rapid at that point in time. That's where you really get involved and they get to know you. At that point, a letter of intent is signed. That essentially, that letter of intent lays out all the terms of the acquisition of the deal. The acquisition of your company. It's not it's not a half page, we want to buy your company. It's the terms of the deal. And that letter of intent goes between the buyer and the seller, and then you inform other bidders of the company that there's a no shop. Now that's an interesting thing. When you notify other bidders on your company that there's a no shop for, let's say, 30 days, that tells the other buyers that they better get serious. Because in 30 days, when it comes off, if it does come off no shop, they need to be serious about what they want to do in terms of making another bid for the company. Due diligence. After you've got the letter of intent signed, there's a lot of due diligence. It's important to have all your paperwork in place before you go into due diligence, before you go into a letter of intent. Make sure that all your financial statements and projections are verified. Make sure that you've got all that data, all those contracts with parties in place in a confidential data room. Make sure that the contracts are in place. Make sure that your lawyer and accounting people are working with you to make sure that everything is clean. Because at that point, you don't want to stumble. You don't want to wait another 3 months while you clean up your paperwork. Very, very important. And then what you do is complete the definitive agreement and attachments, anything that goes together with that definitive agreement, the final agreement. Closing. Final reps and warranties, you determine what, if any, escrow holdbacks, whether it be 10% of the company, 10% of the stock, or cash, hold back in case there's something that the buyer didn't know or didn't find out in that period of time. Get final opinions, assign the contracts, and you get paid. And this is typically, having gone through it a couple of times and having made acquisitions, it's kind of an anticlimactic experience. You've gone through all this work and all this time to sell your company. You've spent years building your company, and then you're selling it. You sign the contracts. You fly home. The money shows up in your bank account on Monday morning. You go, wow, what am I going to do now? I guess I'll take a week off. But it's an interesting experience. Very, very, very anticlimactic. The next step is an interesting step. It's integration. It's integrating your company with the company that bought you. And I advise you to plan ahead when you want to do this. Get to know the CEO of the buying company. Understand what his plan is for you and your company. Are they planning to let everybody go? Are they planning on moving you to New York? Are they planning on just leaving you, letting you do what you want to do? Are you going to be involved in quarterly meetings? Are you going to be presenting to the board on your progress? What is your involvement with the buying company? Get that resolved ahead of time. And then it'll go a lot smoother when you integrate your company with that new company. There typically are a lot of synergies, and you do bring a lot of value to that buying company. Make sure they know what those values are, aside from the price that they pay for the company, aside from just that value of bringing revenues or that technology into the company. Understand what you can bring to the party after the deal has been closed. And that'll help making you happier and making the deal a much better integrated deal than if you didn't plan for it. All right, some of the stages. Yes?
I just have a question on the last slide, the employee retention.
Yeah.
What do you do if you're selling and you have some key employees? And isn't that really taken care of as part of the sale price? Or you have some key employees that you think that the acquiring company is going to want, you kind of bring them into the loop, or how do you kind of deal with that in the sales process? You
want to deal with that as soon as possible before you close on the deal. You want to have employment agreements and basically say we're retaining all of the employees. For the senior employees, these are the terms of retaining those employees. There could be a closing bonus for employees, a retention bonus for them to stay on if they stay on. There could be stock involved or options involved. All of that needs to be taken care of ahead of time.
And do buyers ever carve out a purchase price adjustment for you to stay beyond a certain amount of time?
I haven't seen that. If the person doesn't stay at the company, there's no bonus. I typically, what I'll do is I'll put a bonus program to stay on a year. There could be a bonus at the closing and then 6 months down the road. It's a good question, and it has to be taken into consideration up front. The other thing when you're preparing for the sale of your company, as few people as possible should know within your company that you're selling the company. As few people as possible. Otherwise, you're going to have people that, they don't know what's going on. They're in your office. They're standing in your office door every time you get in every morning. What am I going to do? What am I going to be doing in the new company? All of it. You haven't even closed the deal. You don't know if it's going to happen. What you want to do is to keep it to only the critical people that are needed to make the sale of the company. And then you bring in the other folks and explain to them what's going on and the benefits of this acquisition. So there's a lot of work involved in actually selling your company and make sure that the outcome is the best for the owners of the company and for the people within the company. We'll look at anywhere from 20 to 300 candidates. Depends on the size of the company, depends strategically on how important that company could be to overseas companies. There could be up to 1,000 communications of various kinds, 1,000 emails, phone calls, all of that. All of that should be handled by your professional advisor. You should not be doing that work. You should be running your company. Okay? It's very important during the process of selling your company that you continue to run your company and you meet the goals that you set out for the company in that year. Because it's going to take a few months. It could take 6 months, 8 months to sell a company. Make sure your forecast is accurate. Make sure you're going to make sure that you're going to meet your numbers, because that'll be important to the buyer. You're going to get between 10 and 30 expressions of interest in the company. That's important. You're going to get 15 NDAs possibly, 5 to 15 NDAs in place. You get about 3 to 8 qualified buyers. That's important. A lot of people sell their company and they only have one bidder at the table because they believe that there is only one company that could possibly buy their company. Absolutely not true. I've done it both ways. I've sold a company and I thought I only had one buyer. Not good. The next time, I had 6 buyers at the table. The value of my company went up 300% as a result of having 6 buyers at the table in a very short period of time. Very short period of time. And in fact, I timed it so that when we were at E3, everybody know E3, the video game business? At E3, we were featuring Duke Nukem at the show. And the 6 publishers out there, GT Interactive, Activision, IDOS, and many others, they were all standing there looking at my booth, and they were going, we better get serious about this. And they did get serious. And we sold the company. I think E3 was in May. We released Duke in May 26th, and we had sold the company by June 30th at 3 times what the original bid on the company was. Pretty impressive, but it really says, and a lot of them were overseas buyers. I had no access to them, but my partner, well, at the time, Quorum had, helped me sell the company. Quorum had the buyers to the table immediately. And then you'll get 1 to 3 offers. And those offers are typically at or above what we set that original valuation at. So in the case of video game industry, we can talk about valuations for a minute, and I'll get into it a little more. But right now in the video game industry, it's hard to measure what your company's worth. A lot of traditional tech M&A are going and they look at revenue multiples. They look at EBITDA multiples. They look at headcount and all of that. Well, in today's world, it's rabid buying. People are out there buying video game companies, platforms, technologies, people who have the next big hit, and they are not taking into account a lot of those traditional multiples. So what we'll do is we'll try to set a bar of what we think your company's worth, whether it be 2 times revenues or 5 times revenues or whatever the case may be. We'll say that's the bar. That's what you expect to get for the company at least. We expect that, and then we go from there. But it's an interesting time because companies are getting bid up rapidly because of new technologies, new platforms, cross-border. I mean, people are buying. I know degree is buying in the U.S., has made 2 recent acquisitions, very high-priced acquisitions, $100, $200 million. I'm not sure what that multiple was, but it certainly wasn't of the traditional Tech and A multiple. So that's great for us. That's great. It's great to prepare now because people may be wanting to buy your company later this year. You've got the pins in place. You're going to get those kind of multiples. It's important also, and this is more tech M&A than it is video game M&A, but this still does apply. It takes about 9 to 12 months to complete the process. I think it's in the video game business, it's taking much shorter than that. We've seen 6-week cycles. We're seeing 12-week cycles. It really depends on the company and depends on how well prepared you are to sell your company. Again, OMG Pop had professionals in there who prepared their company for sale. And when they hit their big product, like you will hit your big product one day or your big platform of technology, they were ready to sell their company. So it didn't take any time for Zynga to do due diligence on them. They were ready. It takes 3 to 5 man-years of professional work. So you want a lot of people on your team. What we do traditionally here in any company we take on to sell, we'll put 5 people on the team. We'll put a CEO, expert, negotiator on the team. We'll put a professional writer on the team. We'll put research people on the team. We'll have our CEO involved who knows executives at Zynga or at Microsoft or Google and all of that. It takes a lot of time. And 75% of the time there are other buyers willing to pay more than that first offer on the table. Again, I'm going over something here that I've already mentioned, but we need to be dealing at the CEO level. If you're doing a joint venture or some sort of other alliance, you can deal with marketing or finance or product development or whatever. But when you're selling your company, you're dealing with the CEO of that buyer. Part of the process, and I'm going to repeat this, but it's important to set up that model. The preparation process will forge a better business model for your firm. You'll actually learn things about your company and other companies through this process that you wouldn't learn any other way. Research is critical. You need to understand who those buyers are. And the feedback that those buyers give are amazing. When you get access to the CEO of potential buyers, they're giving you information about their company, strategic information about their company that you wouldn't normally get. So it's a great process for education to go through and understand what's going on in the industry and what's going on with your competitors or your partners. Relationships. Again, not everyone's a buyer, but you will open new doors. You will actually create more business for your company as a result of going through this process. You'll find buyers overseas or potential buyers overseas that eventually become partners. Now, this is avoiding deal disasters. And you're right, we can't nail it down to a specific number, but we're averaging about 80% failure rate on the deals that we know about, and we track a lot of deals. People that try to sell their company on their own. It's really tough to do.
Well, how many people do you get that say, gee, I tried myself and failed, so I need to hire something like more? Do those people try on their own first and then come to you?
I've seen a lot of people try on their own, and that's where we get a lot of our numbers, where the 80% failure rate. There's one of two things. Either somebody's consciously decided that they want to sell their company and they prepare to sell their company. The second is, I tried to sell my company, I didn't sell my company. I didn't get any buyers, or I got one buyer and he lowballed me on the price, whatever. Actually the most common that I've seen is that I've been approached by a buyer. What should I do? That's where we get involved. I've got one guy came to me. He's my largest partner. He's my publisher, and he wants to buy me. What should I do? Should I just sell to him? No. You need to go out and find other buyers. You want to find other publishers that may be interested, even though you are dealing maybe 50% of your business with that publisher. You want to find other buyers so they can set up the price. In fact, that was the case with one of my companies where my largest partner came to me and said, I'll give you X million dollars for your company, sell it now. and do it now and don't talk to anybody else. And I said, gee, I don't know. I'm not sure about this. So I did actually consult with a professional, and I said, what should I do? And he said, you need to go through the process. And so I went through the process. We get a lot of that. There's a huge amount of paperwork. Actually, I just slipped over here. There's a huge amount of work. There's over 60 activities, major activities, broken down into documents and projects and contact with potential buyers that has to go on. And we have something called the World Technology Council, which is made up of CEOs that have sold their company in a wide variety of technologies. They're technology experts. And we identified the areas where you need professional help to put together things like business plans, executive summaries, introduction letters, forecasts, projections. All of that is critical. And that really has to be done by somebody who's done it before. It's a professional that has a system in place to make this happen. You want to understand comparable transactions. That's really important. What was the detail of that last deal? What was the detail of the OMG Pop deal? What was the deal with that last Google acquisition or Microsoft action? We have that inside information. It's very important to understand that a comparable on what those companies are buying for. And we can use that in leveraging your company's valuation. Some of the other things, employment agreements, non-competes, patent analysis, all of that requires professionals. Not only us, but it requires your lawyer and accountants to make sure that you've got all the valuable information you need in your negotiation process. Here's some things that can go wrong. I'm sure some of you have seen this. Confidentiality is very important. You want to make sure in dealing with CEOs of these large companies have a lot of integrity, and they will not share your information or the fact that you're for sale with other people. Okay? If you're dealing with the Vice President of Development, that may not be the case. You need to be dealing with the highest level possible to make sure that those confidentiality issues are taken care of. Internally, you want to make sure, as I said before, that everything is kept confidential and as few people as possible know about what's going on in terms of sale of your company. Theft of technology happened a lot. Happened a lot in the 90s, 2000s, where people were just stealing the technology. They were stealing ideas. Doesn't happen so much these days, but you've got to be careful. Loss of staff. A lot of companies I've seen, especially a while ago, they'll come in and they'll say, okay, give me a list of your staff, what they do, you know, all of that. No. That's not going to happen. I mean, that's not going to happen until later stages when you've got an LOI in place. Otherwise, they're going to be poaching your employees. And then you lose a lot of the value of your company. Wear on management. This can really, really hurt. You guys want to be running your business while somebody sells the business. You need to keep your business running. You need to keep it growing. The best time to sell your company is when it's growing and when you see really good things on the horizon. So make sure that somebody else is taking care of all the legwork, all those phone calls, all those follow-ups, emails, all of that. You run your business. Here are some of the biggest deal killers I've seen. It goes without saying, but it happens a lot. Dealing with only one buyer. You don't have any leverage when you're dealing with one buyer. They can take forever to buy your company. And also, they can buy it for whatever they want because they're the only buyer at the table. You want more than one buyer at the table. Misalignment. Again, this happened to me. All of the shareholders have got to be on the same page. We had a little blip in one of our acquisitions where, this was previous to Quorum, where one guy said, I'm not sure what I want to do. And then right in the middle of the process decided he was going to do something else. So there was not, you need to be on the same page. And I've heard this many times from a lot of you meeting with you yesterday and the day before. Just, you know, I'm not on the same page with my other shareholders. I'm not on the same page with my partners. One guy, he wants to turn it into a family business. Another guy wants to be a technology guru for the rest of his life, and he doesn't want to deal with the fact that you're going to sell the company. If you guys are misaligned, you're not going to be able to sell your company. So get everybody on the same page. Contact at the wrong level again. Deal with the CEO of the buyer and know who they are. Do your research on potential buyers. Again, we've gone over that. One of the things that I do when I go in and I'm looking at a buyer of a company is I ask them how they go about evaluating my company. What's their process in buying my company? Who do they have to get approval? Do they have to go to the board? Who do they have to get approval from? Have I met the board? You should meet the board. If they're serious about buying your company, the board needs to meet you, and you should meet the board. Understand, what their motivation is. Preparing for valuation. In other words, you have to be able to prepare or portray your value properly. Why is your company worth $30 million? This is why. Bang, 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 that's it. It's worth $30 million. It's not, well, I don't know, somebody told me 30, well, I'm not sure. It's got to be, these are the reasons why my company's worth $30 million. And we help you prepare for that. Proper due diligence, qualifying the buyer properly, we've gone over. Orchestrating the buyers, this is very hard. You've got to have these buyers working to bid on your company simultaneously. Don't do it one at a time. Don't go from one to the next. All of them have to be bidding on your company at the same time. It's very stressful. It's it's an intense process, but it yields a much higher value for your company. Yes.
And I see you introduce the buyers to each other and bid face to face.
No, no. But the other buyers know that there's other buyers out there. The buyers do know that there's other buyers out there.
But do you keep the LOI, for example, confidential? Or?
If you've got an LOI from somebody, then you probably go into a non-shop and you stop talking to the other buyers. You tell those other buyers, I've got an LOI, we're serious about this, we're going to have 30 days of no shop, or 20 days or 10 days of no shop while we consider this offer. We'll get back to you in 10 days if we don't come to an agreement. Okay? One of the biggest deal killers, ego. People think, well, I'm worth this. And, oh, somebody just offered me $30 million for the company. I'm worth $50 million now. Well, what's the justification for that $50 million? But I've seen it. You need to set a price. You need to set a price in your head and say, I'm worth $30 million. I need to stick to that. Don't let my greed or ego get involved. Be logical and go down the road of getting the company sold. Now, I'm going to go through quickly. This is a lot of what we've discussed so far. Selling up and selling out is a half-day boot camp going into a lot of detail on how to sell your company and what to do, what not to do. Essentially, there's preparation, valuation, structure, negotiation, and integration. A lot of people attend this seminar. We're going to hold these worldwide. I hope to hold them in Asia here shortly, but we're holding them in North America and Europe on a regular basis. Some of the things that we're looking at, what are buyers looking for, what agreements are critical, due diligence checklists, what do you need in terms of financial statements? You need 3 years of financials, essentially. Hopefully, they're audited or they're auditable, and you can get an audit pretty quickly if they're not already audited. Projections for 3 years. In the video game industry, not so much the audited. Could be reviewed financials and so on if they're moving quickly. But traditional tech M&A, they're looking for audited statements. And you need 3 years of projected financials. Introductory letter, elevator pitch. You need to get your elevator pitch down really well. One or two lines. Why is my company worth $30 million? I mentioned rabbits before. They're really good. They move quickly on you, but they lowball the offer. But they're offers. And you can go to other buyers and say, I've got offers already. And people, they go, what? Oh, okay, we got to get serious about this. And it really brings people to the table. There's many things involved, and you learn a lot of this in the SUSO. And a lot of it has to do with market dynamics. We're in a hot environment now with video games. It's never been hotter. So it's time, if you're ready to sell and you're growing, get ready now and prepare your company to go out to market. That's my best advice to you, because there's going to be buyers knocking at your door as soon as you make that first hit, as soon as somebody's buying your technology. You've got a solid user base of 2 or 3 million customers. They're going to be knocking at your door. Be ready. Financial dynamics, revenue, earnings, growth rate, that has a lot to do with many tech companies. Not as much with video game companies, but it is important. If you've got that basis, they're going to want your revenue base. And what is your leadership? Do you have talent? Your company may get bought for that talent, that headcount. There's a severe shortage of you guys out there, severe shortage of talented people in the video game industry. I mean, it's unbelievable. And people are buying companies just for the talent, to integrate them into their company, to build more applications, to build more games, to build more platforms, and so on and so forth. Interesting, I'll touch on this in the second hour in our second session, but I'll talk about gambling and gaming. A huge trend. What happens when gambling is legalized in the United States or China? Where does our business go in terms of poker, blackjack, and all of those other games? And I'll examine that very closely in the next seminar. It's a huge business, huge business. That's why these companies are getting very, very big valuations. Big Fish is getting into it in a big way. IGT spent $500 million on Double Down. That's unbelievable. Unbelievable. But they need to get into this space because they're anticipating that gambling will be legalized in North America and China and other places. And that just turns the world upside down in terms of valuations, in terms of revenue potential for these companies. Other things like, well, recasting your revenues may be important. Good structure in your company. Make sure all your paperwork's in place. The structure of your company is clean. There's no hidden organizations or no hidden corporations that are, have a piece of the pie or whatever the case may be. All of it has to be disclosed up front. Some of the other things, employment agreements, as a question was asked here before, non-competes, we talk about tax impact, we talk about complexities and cross-border deals. The highest potential price of your company versus the lowest potential price. Well, the lowest potential price is cash, although there's more cash deals being done today. The highest potential price is going to be an earn-out deal. If you're convinced that you have the next Zynga and they're going public and it's going to be worth $10 billion, maybe an earn-out or some sort of stock deal may be the best way to go. If you're not absolutely convinced of that, you may want to go the cash route. How to avoid serial negotiation, other things like that. And I know we're getting to the end of our time here. Some of the other key questions here, typical flow of the negotiation, very important. It's very important to time this properly, and it's very important to do it simultaneously among, I can't emphasize this, among multiple buyers. This is, for you guys, the most important transaction of your life. It is by far the most important transaction of your life. You're going to create a lot of wealth, and therefore you need to do it right, and do it right the first time. So make sure that, as I said before, you may be negotiating with your future boss. Do you want to be doing that directly? No. You want somebody helping you do that so that you're not creating some sort of rift between you and your future boss, because that can get ugly when the integration happens. This is a blatant advertisement on us, but you've got to find an intermediary or an M&A advisor that is centered on our industry. We are only focused on software tech M&A. We have people that specialize in various parts of tech M&A, especially in the video game business where I'm at. We only represent the sell side. We have no conflict with buyers. We only have senior staff involved. We don't have junior people involved. A lot of investment bankers, and we're not an investment banker, a lot of people will say, okay, I want to sell your company, and then they'll put junior people on it. That's not good. You want the most senior, experienced people you can. Are they international? Are they respected in their field? And do they have a track record? So, this is what we do. Can I ask any questions? You want to use the mic if that'll help?
Hi, Leonard from Plarium. We do social games. Two questions, please. First of all, what's a common failure rate for managed deals? You keep saying about non-managed. And secondly, when's the right time to sell your company?
Two very good questions. I'll answer the second one first. The right time to sell your company is when things are good and you're growing fast. The best, people think, oh, I'll wait and I'll sell it when things start to slow down. Now, the best time to sell your company is when things are going really well and you see real potential in terms of your growth. In a managed process, when you have professionals involved in the business, about 75% of those deals, you get the offer that you were looking for. You're getting the valuation that you were looking for. You said it from the beginning, I want to sell my company for $25 million. 75% of the time, if we've agreed on that price, you're going to get it. You're going to get those offers. After that, the majority of those deals close, and you're on your way.
So 75% success on managed deals?
75% of those deals are you get the offer that you want, and then you have to go into due diligence, and the majority of those deals actually close. Yeah, over 50% of them. In some businesses, it's 100%. In some, it's 60%. It's comparing apples to oranges. Depends what's hot at the time. Software as a service right now is hot as well as video games, and it's almost 100% success rate. Other businesses, things can fall apart. People don't meet forecasts. They have legal problems and so on and so forth, and those deals may fall apart. Even though you've got the offer you wanted, you may not be able to close the deal because you didn't complete the due diligence. Other questions?
How do I pay you? I didn't see your first few slides, but how do you normally structure the deal? Do you take a transaction value, take per hour?
We base our compensation on the success of selling the deal. There is a retainer that happens for 6 months. It's minimal. It covers about a third of our costs, but we get paid when you get paid. When you get paid and if you get paid. And if it's a cash deal, we get paid in cash. If it's stock deal, we get paid in stock. But we are motivated to sell your company. If we don't sell your company, we don't succeed, and we don't make money.
How many sellers do you turn down?
How many sellers do we turn down? Well, in terms, I'm not sure I understand the question.
If I come to you and you look at, say we're pre-revenue,
Oh.
great IP.
I'm sorry.
Everybody loves us. We're talking to Disney, we're talking to EA, we're talking to all these people, but it's not there. The value's not there yet. Would you say, from your professional opinion, that's not your time yet? Slow down, come back in a year.
Absolutely. We do that a lot. We have companies that come to us and they may have very minimal revenues. They're just at the beginning of their growth cycle. And we say it's really not time to sell your company. You've got to establish some revenue. You've got to establish some customers. It's really important to establish that. You're not ready to go to market. And it doesn't help us to force you to go to market. It's really when we think you're ready to go to market. And we will help you in that meantime. I've been in the video game industry for 22 years. If we can help you find those customers, if we can help you find those publishers, if we can help you find an overseas partner, that's what we're here for. We're here to help you grow the company so that when you decide to sell the company, hopefully you come to the Quorum Group and we'll help you sell your company. But,
How long is that due diligence process? I mean, is that just a simple interview? Is that talking over drinks?
That's a good question. It usually takes about a week or two about getting some information on the company. We'll look at your financials. We'll look at your partners. We'll look at your technology, obviously all on a confidential basis. But very quickly we can see whether or not you may qualify to be ready for a sale. We don't want to mislead you in any way. We don't want to drag it out. A lot of people will charge a retainer to do what you're asking, to determine whether or not you're right for sale. We'll tell you right up front. You're right for a sale, or you're not right for a sale. We've done almost 300 transactions. We know when you're right and ready and when you're not ready. Any other questions?
I think we're about 5
evidence in your next step.
Okay.